will be on 3 critical financial controls for reserve management. And we are actually hosting this exact same webinar tomorrow at 1 p.m. Central Standard Time. So if you enjoy this today, please feel free to spread the word to your colleagues so they can sit in tomorrow. My name is Lacey Orr, and I will be your host for today. In case you are unfamiliar with environmental risk communications or ENFOS heading into this webinar, ERCI builds tools, training, and reports for duty holders to recognize, measure, and display their environmental and AROs. And here at ENFOS, we're a cloud software platform. We manage all of your complexities around remediation and decommissioning, and this ranges from the financial all the way to the technical information. Now for today's webinar, we'll be discussing the topics that you see here on your screen. And since all of our attendees are muted for this webinar, you will be able to submit any questions that you have throughout the webinar through the Questions tab that you should see located on your dashboard. And we will try to answer those questions live at the end of the webinar, but for those who don't get answered, we will answer those questions through a follow-up email to you. And we do welcome all discussion at the conclusion of the webinar, so please don't hesitate to send any of your questions in. Also, today's webinar will be recorded, and we will make it available to all attendees within the next few days. And we will also be publishing this recording on our YouTube page if you ever want to go back and access it again. I'm going to hand it off to Roger Well, who is a speaker today, for him to introduce himself.
Hi, everybody. I would second what Lacey said and welcome you to the webinar that we're hosting today with John Rosengard and his company. My background is through environmental remediation. I have spent over 26 years in the industry and in a lot of different roles, starting with the technical, out in the field, doing site investigations, remedial investigations, feasibility studies. I've done project management work as well, and also spent quite a bit of time with ENFOS. ENFOS, as Lacey mentioned, is a software company that specializes in helping customers manage environmental liabilities through a strategic information management platform. I spend a lot of my time and effort working with customers to help them optimize their business processes, improve their decision making, and manage their risks, and have spent the last 2 or 3 years focusing my efforts on operational effectiveness, and have written several white papers on that are available on our website as well. And I just look forward to talking to you today. Thank you.
And now we'll let John Rosengard introduce himself as well.
Good morning, everyone. As Roger and Lacey said, welcome. I repeat that as well. I just want to thank you for joining our webinar today. My background is in parallel or similar to Roger's. I've got 21 years of time in with environmental risk communications, where I'm the founder and creator of our Defender software suite, which helps with reserve management, but also counterparty tracking, portfolio analysis, and decision analysis on environmental liability portfolios. With that, we've really developed a competence in helping companies and port authorities on the GASB 49 side develop their audit defenses, but also their visualization or anticipation of what future liabilities are going to be. My background, in addition to the information displayed there for my education, I've also got 6 years put in with a time off for good behavior at remediation contractors. I used to work for Sevenson and OHM Remediation Services, for those with very, very good memories, and also worked for FMC Corporation in Chicago, as well as Santa Clara, California. Thank you for joining us today. I look forward to talking with you later on.
Okay, so before we get started, we actually wanted to do something fun for a second here, and we are challenging you all to caption this cartoon that you're looking at on your screen right now. And it's just a guy working on an abacus with 2 employees behind him. And after the webinar is over, we will select a winner and send a special prize to them, so the funnier the better in this case. And you can submit your captions through the Questions tab that you'll see on your dashboard as well. so go ahead and take a few seconds if you wish to submit your caption.
And John, maybe you can share yours, since you're not eligible for the prize, just to kickstart the ideas here.
Sure, thanks. I'm sorry to hear that. That's something we didn't discuss in the rehearsal, that I wasn't eligible for the prize. But okay, one of the thoughts I had was he thinks the red ones are billions. Sometimes we see companies change systems from as they grow and evolve, and it's often important to remember that environmental liabilities jump off the scale. So when I saw this first time I saw this, I thought they might be billions. We might be talking about environmental liabilities, and they might be way off the scale. The second one I thought was he never trusts what comes out of PeopleSoft or SAP, depending on what your organization's deployed. So those are my two guesses.
Very good. And mine is way more basic than that, but my caption is, if these two guys will get off my back, I actually might be able to get my work done. All right. So anyway, send them into the questions panel, as Lacey mentioned.
Now, before we get started, I noticed we did have a few people joining a few minutes ago into the webinar, so I just want to remind those that you can submit questions throughout the webinar through the questions tab on your dashboard, and we will get to those.
All right, we're going to start the technical aspect of the presentation, kind of going over, why is this important? Why are we talking about financial controls today as part of an opportunity statement? About 2 years ago, we commissioned an executive survey with the AHC group, and Dwight Bedsole actually led that effort. And we used that information along with just general engagement with our customers and the marketplace at the executive level. And I took the liberty of coming up with 4 primary areas that I would say what every executive wants. And each executive will talk about these in different terms, but I'll try to summarize them. Number 1, high visibility. A lot of times this comes up as we want no surprises, or we want to minimize surprises. So there's definitely a risk management component there if you want to get more technical about identifying potential issues before they become problems, being able to take quick and effective mitigation efforts if we do have a problem. So this is number 1, high visibility. Number 2, strategic alignment with corporate value drivers. Are we doing the right things? That really goes to answer that. Does our organization, our company's core value drivers, what we're doing in remediation or in decommissioning, are we strongly aligned? And do our operational systems align with those goals? So that's number 2. Number 3, improved effectiveness and efficiency of operations. I don't think that needs any additional explanation. And number 4, I would say, is certainly more of the leading edge or the newest area that comes up during conversations, but it's around data-driven decision-making and having a data-driven narrative so that I can explain what has happened, I can explain what we think will happen, and I can back that up with data, with analytics, with information. And I can leverage technology to help tell that story to the board of directors, to the executive management team, and to all the stakeholders in environmental. What's a good presentation without a Venn diagram? So I wanted to throw this in here. The area that we're really targeting in on for financial controls is this best practice zone, and it's really the convergence, in my mind, of 3 broad areas. Project management, right? Those are the fundamentals of what we do. Scope, schedule, budget, and deliverables, right? There's a lot that goes into that, but that is, using a football analogy, the blocking and tackling. Finance and accounting, right? These are managing the disclosure and reporting requirements that John mentioned, and we'll talk more about here in a little bit. It's making sure we have financial controls and financial reports in place. And then the third bubble would be technology, right? It's 2015 now, folks, so technology is involved in every single thing we do. We wake up in the morning and we're probably turning on our laptop or our mobile device and we're reading the news. We might be logging into some dashboards to analyze something that's going on at work. Most organizations now are bring your own device, so you're able to, use your mobile devices. When you get in the office, besides getting your cup of coffee, probably the first thing you're doing is sitting behind your computer and doing work. So almost all information now is digitized, workflows can be automated, and there are best management practices around the use of technology. But the convergence of those three really takes financial control into the new realm of possibility. John, I'll let you talk to this slide.
Thanks, Roger. Effective and efficient project controls are always aligned with the two roles of internal and external auditors. And the reason I bring up this topic is that environmental accounting has gotten much more complex in the last 5 years. And that's one of the things that ERCI does that perhaps ENFOS is influenced by, is that we look at how the accounting policies and practices that are out there really do change what gets recognized, measured, and then displayed as an environmental liability. So one of the roles that internal and external auditors really enforce is to make sure that GAAP, generally accepted accounting principles, are followed. And there are two key aspects to that. Number one, first of all, it's important to make sure that there's relevant information being produced, like past, present, future spending data, and as well as our forecasts being faithful representations or fair values these days of what environmental liabilities or budgets truly are with our current knowledge. And again, I want to underscore that liabilities and budgets or life cycle forecasts and current budgets tend to be two very different things and produced under very different circumstances as well. Auditors have the purview to check on both. When an auditor is looking at environmental liabilities, key questions keep coming up time and time again. Are we measuring similar liabilities in similar ways? Do we track our spending? And Roger's going to discuss earned value shortly in this presentation, so that we distinguish between the prices that we're paying and the values we're receiving, referencing the data and the information that was in the Venn diagram just in the previous slide. Working down the liability often is not as simple as spending through a project budget. My third point here is that good capital stewardship means borrowing the lessons from the past. Let's move on to our next slide, slide 11. This next chart lays out a remedial project at mid-construction. We can see the spending is the blue line accumulating from the lower left to the upper right, so cumulative spend there. We also see cumulative commitments in the green line from the mid-left to the upper left as well. And that in turn leads us to the orange line, which is the something that I call the liability burn down line, which if we stop today, we'd call that what liability is left. And note that the spending doesn't perfectly remove the liability in this example, and that liability isn't zero when we're finished with this project. These outcomes where spending doesn't match our liability burn down are pretty common in environmental liability projects. That happens because we don't resolve every single risk with spending. Regulator community acceptance, those have to be earned. Counterparty risk, where the PRP pays off their share before entering financial stress or bankruptcy, requires monitoring and sometimes a financial step called assurance or securitization. To make all of this work, project controls can and should explain what liabilities remain while and after a project is implemented. The biggest risk that we see being taken is saying this project takes care of that liability, or this project budget is the value of the liability. Those are risky statements. Auditors and liability portfolio managers have been hurt by complacency or bravado when it comes to those statements. So rarely is my conclusion, rarely is your residual liability going to be that perfect sum of uncommitted funds or unspent funds. Let me hand this back to Roger to cover the business model for project controls on environmental restoration projects on slide 13. I'm sorry, on slide 12 and 13.
Great, thanks, John. We're going to move now into the discussion of the 3 critical financial controls. And I'll start that with a higher level view of a potential business model that an organization could deploy. And really, I want to talk about 4 areas here as identified by the different colors on the chart. Area 1 is the business objectives. This certainly gets into governance model, what types of controls are specific to the type of portfolio or the type of liability that's being managed by the company, SOX certification issues, and then also business risk management. So these are the business objectives. This is out of scope for today's talk. Certainly this drives the linkage between your operational model and the corporate value drivers. The middle area, which is a light green, these are the controls. So this would fit within your control model. Organizations have internal controls in many different areas. You know, a classic example would be segregation of duties or delegations of authorities around spend authorization. So that's an example. Automated controls. These are also sometimes called configured controls. These are business rules that can be established within a platform and then enforced just in the course of people doing their work. We're going to spend time talking about automated controls in the remainder of the presentation. Reporting controls, and then finally security controls. So we're going to focus on the internal and the automated area, but just wanted to point out that there are other types of controls that an organization would want to put in place for a comprehensive business model. The light gray area is the technology enabler. So we would have an operational system. I call that the front end. So this is where the owner with their finance and accounting professionals, their remediation project management professionals, and other support staff would collaborate with their supply chain, such as environmental consultants, contractors, or other third parties. The next area is the back-end system. This is the ERP, or the Enterprise Resource Planning System. This would be the backbone of your corporate IT stack. These could be systems such as SAP, PeopleSoft, Oracle Financials, to name a few. And then the green area, this is the people side of the business, so the manual and procedural controls, right? Obviously, it's still a people business. Labor, both your internal labor as well as the supply chain cost matrix is heavily driven by labor, and people need to do their work within a controlled system. So this is a package model kind of looking at how financial controls would fit within the overall structure. This slide depicts an integrated business process management approach, and it's necessary to enable financial controls. So the key point that I want to point out initially here would be that financial controls are not a standalone management technique. They need to be linked and tied directly into a larger business process. And this is what this screen is showing. So if we have 4 primary finance work areas, forecasting and budgeting, you would include reserve management in this bucket, lifecycle forecasting in this bucket, annual budgeting would be in this bucket as well, along with all the change management associated with trigger events or reductions or increases in liability projections. So this is forecasting and budgeting. The second area would be vendor proposals. We all know the work is outsourced predominantly. So there is strong linkage with vendor proposals and purchases, which are the work commitments that we're going to be talking about. as a financial control. And then finally, the expenditure, as designated here as invoices in recovery. The bottom green area, the work breakdown structure, will be the first element of the three critical financial controls we'll talk about. So I'll get more detailed on that. So that's the work breakdown structure. Number two, the orange octagon with the number 2 is the second financial control, and that will be the management of work commitments against planned balances or budgets. And then the third area is spend controls, where we're looking at managing expenditures against an approved work commitment. That concept sounds very finance and accounting driven, but if you put your project management hat on, this is also project management 101. I have an approved work scope, I have an approved cost around that. That's broken down into tasks and subtasks, possibly, like a good project plan would have. And then I'm going to manage my work complete and my spend complete through time for earned value management. So even though this looks very financial driven, you can look at this through a project management lens as well. All right, control number 1, work breakdown structure control. I won't go through all the words here, but I'll hit some of the highlights. The first thing is I want to introduce the concept of a harmonized work breakdown structure. So a harmonized work breakdown structure is a WBS that's uniformly applied across all financial activities, from forecasting through spending on every project in the portfolio. Okay? So that's a long definition. I think most all of us can visualize a work breakdown structure, but it's absolutely necessary to be in place across all the transaction types that we looked at on the previous slide. If it's not, there's absolutely no way to put in place financial controls through the entire workflow process. So in other words, if I'm using a work breakdown structure for my long-term forecasting or my lifecycle management, that is entirely different from my work breakdown structure on my expenditure capture, it's going to take an army of consultants and analysts in order to link that data together. So the best practice is to harmonize that across the entire spectrum of those processes. The other element of this is if you have multi-project portfolios, either you may be managing a global portfolio, or you just may have many remedial projects taking place across North America, as an example. Standardizing that across the project portfolio is another critical element from an organizational viewpoint. Not necessary from an individual project management standpoint, but if you want to take that up to the programmatic level, you need to consider that as well. Okay. An example. So what we're looking at here is an example 4-level work breakdown structure. Level 1 being phase of work, level 2 being activity, level 3 element, and level 4 component. Don't get hung up on the names. These are pretty generic, but companies that we work with use different terminology or different labels for their WBSs, so I don't want to get too hung up on terminology. What this is showing is that the WBS, the work breakdown structure level of detail, gets more granular as you get closer to the work being performed. So if I'm doing a forecast and I'm doing a 30-year, 40-year, maybe 50-year cash flow forecast, I'm probably doing very well if I can do those estimates by work phase and by work activity, such as, in my example, remedial implementation as my phase and groundwater remediation as my activity. As I'm ready to commit the work and I move into proposals and purchases area, I should be able to get more granular into my WBS from my environmental consultants or contractors, because now I'm closer to the time where I'm going to do the work. So in this case, in my example here, the estimate is going down to 3 levels, and now I know that I have some engineering design costs that are part of groundwater remediation. That's part of my remedial implementation phase. Once the work is done, now I'm down to my 4th level of detail. So that's the cost component. So I can look at an expenditure, I can look at a project cost tracker, and I'll know that I had direct labor that was part of engineering design, that was part of groundwater remediation, that was part of remedial implementation. So a very basic example here, but I think you can start to see now how tying a harmonized WBS across all transactions, whether it's for the lifecycle forecasting all the way through the invoice, is critical for financial controls. All right, I'm going to move into the work commitment control. So the commitment control, the definition that we're providing today is that this is the monitoring and controlling of the expenditure commitment against a budget or a balance. Okay. We've already talked about the harmonized WBS being essential. There will be 4 key financial variables that we'll look at as an example. The current balance, the open commitments, the available to commit, and then the new commitment request amount, i.e. the new proposal. Okay. All 4 variable amounts change through time as work progresses, so there are many moving parts. It's also typical that on a remediation project, there are going to be many work commitments, not just one. Sometimes these will be based on a time period, like a work commitment for a given year. Other times it's a work commitment for a certain type of work. Obviously, you'll have different work commitments for different vendors or suppliers, depending on what they're doing on the project. So this is not a one-to-one issue. You would have a single reserve plan or budget balance, let's say, but your work commitments are going to be coming at you from different vendors and different time frames throughout the life cycle. So let's look at a tabular example here. So in my example, I've got 2 levels of a WBS. I have phase and I have activity. So you can see that I have a site characterization phase, and I have 4 different activities that have been budgeted as a current year plan. I have some project management, some investigation, some monitoring and sampling, and some reporting. That's the current year plan that was set as a baseline at the beginning of the year. I'm tracking my expenditures to that level. That's my current year expenditure. So I have a current year balance in place. I'm also providing I'm providing work commitments as I approve work from the suppliers. And that's the open commitment. And then the last column is the available to commit. So the balance, the open commitments, and the available to commit are critical, the 3 of the 4 critical financial parameters to be able to track and manage for the commitment control. So you can see in that last column, my available to commit tells me at any given time, do I have money left in my current year's plan to still approve for future work that is not in a purchase order or work order at that time. So if I go down to remedial options appraisal, engineering study, all the way to the right where I have the beige highlight, there's a $0 amount in the available to commit. Okay, so there, I do not have the ability to spend any more money there because I can't even do a work commitment. Now the question comes up, what happens if I need more engineering study? Well, then that takes you back to the plan where you would have to go through your organization's plan change or your change management process, a reforecast. Maybe there was a trigger event that you need to replenish the budget. Okay. The cell right above that in the green for remedial options, alternatives evaluation shows $4,000. So that tells the project manager at that point in time, they still have $4,000 that they can release to a contractor in the form of purchase order or work order. Okay, so this is a type of a tabular control report that can be produced in real time. There are many other options around configuring this. This is in the lower left-hand corner. We have 4 different options identified here that companies have deployed. They'll do their work commitments by their current year plans by WBS. That's this example. They'll do a current year by the plan total. So the way to look at that is if you look at the bottom line where it says totals, and I have $394,000 to commit still in my current year plan, that is a configuration option. So that would be an organization that says, I don't want to control my work commitments to the WBS level. I just want to control my work commitments to the plan total for the current year amount. So I would have $394,000 still to commit. So I could commit more or less in any one of the WBS rows above it. You can do work commitments life cycle by WBS and then life cycle by plan total. So the difference with the configuration option 3 and 4 is that instead of a current year control, budget control, I'm doing a life cycle control. So that means it may be easier for me as a project manager to accelerate work this year that was in my next year's plan, because I'm looking at a life cycle balance on my control as opposed to a current year only. Okay. All right, the next control is the spend control. So now we have a work commitment, and we're trying now to project manage this. Right? We're managing our purchases and these work commitments, but I also have a project management framework in place to try to manage the project successfully. So the definition here is that this is the monitoring and controlling of the expenditure against a work commitment for an entire project or a sub-project. I won't get into breaking up projects into sub-projects, but that's obviously a best practice, particularly on larger or mega remediation projects where the entity is just too large to manage as a single project. The 3 financial variables used for the spend control are your commitment open amount, your available to spend, and then the expenditure being processed, i.e. the new invoice that's coming in for your review and approval. The commitment of open amount would be, let's take an example of a purchase order. Let's say I did a purchase order for $100,000. I've already spent $75,000, so my commitment open amount is $25,000. So that's what I've approved in terms of the spend or the potential expenditure, but I haven't proved the actual invoice yet. The spend control can be linked to earned value. So the spend control I'm going to explain has to do with making sure that the invoice or the expenditure totals do not exceed the commitment amount. So that's looking at the actual cost of work performed. The second variable you need is the actual work completed estimate. So I may be 50% invoiced, but maybe I'm only 25% done with the scope of work. With those 2 variables on any task in a project, I can do an earned value calculation to determine my cost performance index and how well I'm actually trending on any given task in a project. So my example on the spend control looks similar to what we looked at on the work commitment control, except now I'm dealing with some different parameters as my column headers. So I still have a 2-level work breakdown structure shown here, a phase and activity. So if we look at the very first one, the activity called monitoring and sampling, I have open commitments of $1,500. I have a purchase order balance a PO number 1 of $1,500, and I have an invoice against that purchase order come in for $1,500, that is a validated invoice that a automated spend control system would validate and say, yes, this expenditure can be approved. Now, it can still go through a human review and approval process. That's absolutely essential, but it can be flagged and validated either as successful or unsuccessful in an automated control environment. If you go down to groundwater plume control, invoice 1 in the orange-red colored highlight, it shows invoice 1 for PO 1 of $6,000. The automated control would reject this invoice early in the process because the purchase order balance is only $5,000, right? So again, that's just for one activity of the overall work commitment. So just like on the commitment controls, we have configuration options that should be part of the management system. The configuration options for spend control could be on the purchase order total only, right? So if I have a purchase order for $100,000, I don't care what the makeup of the spend is, I just don't want to exceed the PO total. That's a legitimate control. Purchase order and change order individually. This is another area that gets talked about a lot in meetings where I'm at. Let's say I have a $100,000 purchase order, but I have to do a $25,000 change order. My new PO amount is $125,000. Do I want to control the spend based on two different proposals, the first one being $100,000, the second one being $25,000? So, or do I want to limit the spend control just to the top level amount? Okay, so again, that's a choice. It's a configuration option that an organization would make, but certainly it's an area that comes into play when you are doing a lot of change orders because of, say, uncertainty around the project. You may want to control spend to the change order total as opposed to just the new PO total. You can do the spend control by work breakdown structure, as is in my example. Okay? So in this case, I may reject a $6,000 invoice, even though I still have an overall purchase order balance amount that would easily take that into account. But it's rejected because I had approved a certain amount for that activity. And I don't want the risk of exceeding this budget towards the end of the project to come up because I've been exceeding individual activity budgets within the overall scope. Again, that's a decision each company has to make on how tight they want their controls. The last configuration option, which I don't show on this chart, gets into the rate sheet item quantity. Many times these costs on these invoices are actually coming off of an approved contract and a rate sheet. So part of the financial control on spend control is to determine what level of control do I want on my unit items and my unit item quantities within an individual project plan. Okay, so if I have a hydrogeologist for $90 and I have 10 hours approved for that, do I want to control my expenditure to that quantity of 10 based on a validated rate of $90 an hour? Again, those are choices that an organization would make when they're setting up an automated controls environment. So that gets us to a summary slide here where we kind of want to put it all back together. We talked about this slide at the beginning of the presentation, and we've gone through and talked about control 1, which is the WBS, Control 2, which is the work commitment control, and Control 3, which is the spend control. And again, trying to create a visual to put it all back together for you. And I'm going to turn it over to John, who's going to also put in some summary remarks here.
Thanks, Roger. From our perspective, these three critical points really are the WBS, the commitments relative to the plan balance, and the spending relative to the commitments. And a couple of notes on each one. One, if we're going to live in this world where there are fewer people doing more things, then we've got to focus on what really truly is leveraging. And ENFOS's and ERCI's experience in working with environmental liability portfolios is just identical here. We see that having a common WBS means that you're measuring what you intend to manage. So getting a WBS in common across an environmental and or an ARO portfolio, absolutely pivotal. If you don't do that part right, it just becomes tougher over time to do that. When we see companies merge together, when we see new sites add to a portfolio, this is one of the tougher things to do, to get the incumbent consultant to say, stop estimating your budgets for next year, stop proposing your work the old work breakdown structure way, transition to the new one. So enforcing that work breakdown structure and applying it from the whole procure to pay, which is the current buzzword for forecasting, proposals, purchases, invoicing, and so on, that Roger noted. Procure to pay really does tell us, start with the right WBS, we'll be able to leverage our time much more efficiently as we go on. Another couple of points about Octagon number 2 there, about commitments not exceeding the plan balance. What we help our client base do is work with something called a watch list of what's not in the provision or the reserve or the plan balance today, but what prospectively can be, and perhaps even a Monte Carlo model around what are the expected values of prospective things that may need to go into that plan balance. So again, it's just solid discipline, just common sense to ensure that there is communication around what's in the plan balance, but also what's out of scope for the current plan balance. And that may include, again, for being out of scope, what's on the watch list for an entire organization. The final point, again, just common sense. What you measure, you manage. Spend cannot exceed your commitments, and that's just, again, a logical part about having these good systems and relying on them and trusting them to do what they tell us to do sometimes. So again, just to sum up, these three elements have been part of project controls on capital projects for more than a century. It's good to see that they're getting applied to environmental remediation liabilities because they should be managed with the same basic rules in mind. With that, we're ready with our next slide for questions or comments from our audience. So let me hand the presentation back over to Lacey, and we'll go from here.
So as John said, that does conclude our webinar today. And before we do jump into questions, in case anyone has to go, I want to thank you all for participating and joining us today. And I also wanted to provide my contact information in case you have any questions regarding today's content, or if you would like a copy of today's PowerPoint that we used. My email is just lacey@infos.com, or you can also reach me by phone at the number on your screen. And I think with that, we'll start answering some questions.
Okay, let's do a time check. 9:47, so we have a few minutes to go over some questions. We did get some questions, and I'll throw the first one out here. The question is, I manage a diverse portfolio of sites, and it seems difficult to harmonize the WBS across different types of projects. How would we handle this? So this is a very good question. I see this a lot in diversified companies, diversified manufacturing companies. We would see this with integrated oil and gas companies as well. We see this with pharmaceutical companies that have some legacy chemical liabilities on their balance sheets. So it's a great question. You know, the way that we would deal with something like this is, first of all, we would want to make sure that if you cannot harmonize the WBS across different project types, right, like a refinery remediation project versus a bulk storage plant process. If you can't do that, and we would probably talk to you about why you can't, there is an approach that can be configured to do that, and that would be to have multiple work breakdown structures based on project type. So in my example, I might be using a typical RECRA phase of work and work breakdown structure for my refinery remedial effort, and I might be using maybe an underground storage tank work breakdown structure system for my my bulk storage plant. What you would do then is you would have multiple WBSs based on project type in your portfolio, but you would have a parent level above that, which would be your corporate standard WBS names, and each one of the child WBSs would map to your parent, so that at the project level you can plan and manage and control work to your specific project type WBS, but at the company or the organizational level, I can still run reports across the entire portfolio in this parent mapped WBS. So that would be my answer to that question. I'm going to there was another question. I'm going to read it, and John, why don't I let you, whoops, sorry. Give me 1 second. Okay, the question was, all right, John, you ready? Question is, can you adopt this to handle accrual-based accounting?
Well, certainly yes. Accrual-based accounting is used in place for one type of money that a corporation uses to manage their environmental liabilities. Just to give a quick overview, there are reserves that allow for accrual-based accounting or require accrual-based accounting because you're setting aside money today for spending that will occur tomorrow. That's classic for environmental remediation liabilities. So there's accrual-based or reserve-based accounting. There are also operating expenses where you're paying as you go. You have an environmental expenditure today, and you're charging it to your income today. You're not using last year's money or tomorrow's money. You're just using the immediate funds available. So that's operating expenses, the second type of money you can use. Capital expenditures, you spend the money today, you write it off tomorrow. That's the third type of money that corporations in US, Canada, worldwide are using to manage environmental liabilities. The fourth are asset retirement obligations, where you set up a gradually increasing amount for decommissioning, dismantling, abandoning, and basically terminating the useful income-producing asset at the tail end of its useful life. So 4 types of money. But to go back to the first one about accrual-based, yes, it's important to set up those plan balances with the expected value of what the liability will be. And again, that's not what this year's budget or what the next few years' budget is going to look like. It's important to set up that accrual down to whatever level is necessary. But certainly the site level is the minimum for auditing. You have to have a site-specific balance. You can't have a giant pool of, we'll have X dollars ready for whatever comes at us. You can't do that. That's been audited out of the ecosystem of accounting here. When you look at environmental liabilities, you've got to have a site-specific number and expected value number, which means a weighted average of different outcomes. One might be the laws are never really enforced. There's never an NOV. We don't spend anything. That may be the most optimistic cost outcome. The other may be there's aggressive enforcement actions starting yesterday, and we're just going to jump into it with both feet. That's on the high end of cost. So expected value means weighting all that in, and that's again where the line kind of blurs between what ENFOS does in tracking the spending of the liability in their platform system. A phenomenal technical accomplishment, by the way. But in tracking that, what ERCI does is help with that measuring of what is the Monte Carlo model, the expected value of all of those different outcomes. What do those decision trees look like to again start defining what you're going to be tracking. So again, two key components, just really having a site-specific estimate and an expected value estimate, and from there, the accounting literature is really starting to propagate and multiply and get more complex. We're now looking at things like fair value. What would your biggest competitor value your liability at? That's another benchmark to look at and evaluate. What belongs in your reserve or in your plan balance for your given environmental liability. So it's evolving over time. These are becoming more complex, and of course, as we're moving toward this world where we're trying to do more with our phones, our tablets, do more on the road, do more work with fewer people, automating these activities, making them consistent is absolutely essential. We're managing liabilities in different ways and documenting the liabilities in turn in different ways just makes an auditor's work more challenging, but also the portfolio manager's work more difficult. We're all trying to clean up more sites for less money. That's all part of what we're trying to achieve together here. ENFOS has a really just a tremendously capable cloud-based system to enable that work to be done. Our work in characterizing the liabilities of looking at things like the counterparty risk of a small PRP or a large PRP, not paying their share because their credit rating is X today and might degrade to Y over the next few years. Those are all different factors that go into measuring what you try to manage. But again, it all starts back with the very fundamental ideas that what we're trying to do is come up with relevant financial data about how we measure the liability, so they're relevant to a few people, but a few very important people. And it's also a faithful representation of what the liability is. We're squaring up with the shareholders, we're squaring up with management, and we're squaring up mostly with ourselves about what the fair value of a liability is today. With that, let me throw it back to you, Roger and Lacey.
Yep, we have a couple more questions we'll try to get in here. Next question is, what if we contract a supplier across multiple activities? Does this approach break down the supplier's invoice costs and map to the relevant activity for tracking? So the answer is absolutely yes, and that is a very common occurrence just because of the way this work is outsourced. Typically, you know, there's a primary environmental consulting company managing the majority of the work across multiple phases as well as across multiple activities. So the harmonized WBS would be used for your planning and budgeting, as we talked about. When you have conversations with your suppliers about the work that you're going to commit to them, or if you define a scope of work and you're looking for a contractor or consultant bid on it, you will mandate and enforce the use of your work breakdown structure on the vendor proposal, so that they might give you some kind of a matrix that identifies project tasks and deliverables, but they're going to provide the cost breakdown for that work commitment to that activity level, so that when they go and do the invoice, they're going to give you the lowest level of detail, like labor, equipment, material. They'll give you possibly a cost element like field activities versus reporting activities. And then that would roll up to the activity that was part of their work proposal in the first place. My example that I used was groundwater remediation. So you'll mandate and enforce the work breakdown structure to your suppliers. You'll push the data entry or the electronic submittal of the expenditure. You'll push that to the suppliers using your procedural documentation, so that when the invoice comes in for your internal review of it and validation, it's all lined up, and then through time you're able to track all the historical costs to the activity level, and it would be multiple activities, which was the basis of the question. And we have another question. What is the best way to handle unforeseen changes in scope based upon field assessment results? Well, that's a $1 million question, so that was a real good question. And let's face it, unforeseen changes in scope is a way of life in remediation, right? Remediation is a complex service with high levels of uncertainty. Therefore, you need a very strong change management system in place. You need change management for the accruals and the reserves. You need change management for the work commitments as well. So, you know, typically the best way to handle unforeseen changes in scope is to follow the company's procedure for making accrual adjustments. Sometimes that's based on a financial calendar. Maybe we do it once a quarter, and then annually we have a deep dive to true up my balance with the projected remaining liability. So it might follow a financial calendar. It might follow a trigger event process based on some material threshold for the change. But you certainly apply the work breakdown structure to the changes, in addition to other data attributes like the reason for the change, right? Using a normalized or a fixed list of the change reasons so that I can run analysis and reports on my change reasons across an entire portfolio as well. But you would follow the procedure that the company has in place that can be automated, and you would stay with the work breakdown structure. And then what you have is you basically have created a new layer on that project. I had my initial estimate, and then, you know, on January 23rd, I went through a change review process. It's been approved, and I've added or I've decreased to the budget amount, and it's within the same WBS environment. If I added, say, $50,000 to a budget, now my available to commit is also increased by $50,000, right? So now I can go out and get work commitments from vendors to do that new work based on that scope change. Okay, Lacey, I'm going to turn it back to you. I think we are finished with the questions, and it's 10 o'clock Central.
Yes, thank you all again for attending this webinar. And if you do have any more questions or you would like a copy of the PowerPoint, you can always email me at Lacey, L-A-C-E-Y, @infos.com, and I will be sure to get that over to you. Have a great day, everyone.